Hey, what's going on, everybody? We are live, and today we're going to talk about acquiring businesses. All right. And this is like the perfect setup and call. And I'm actually upset, Madeline, me and you didn't lead with this because anytime you buy a business, you need an accountant and your finance guy.
That's right.
So we want to help you guys because it's very, very popular to start buying businesses. There's a lot of people that have roll up strategies where you want to buy bits and pieces to that are going to service one specific client or market, right? And then obviously you can roll up for growth. So, Madeline, what are some of the things that you start to look at when a client wants to buy a business? Like, how do you walk them through it? And then I want to give my perspective from the lending side.
Yeah. So right off the bat, I want to make sure of a few things. Now, there's two sides that we are a part of, either the selling side or the buying side. So I would say on the selling side, if you're looking to sell a book of business, we're focusing on really clear records, accurate financial statements, filed tax returns, and most importantly, that the tax returns actually match to the financial statements. So that way that doesn't cause an issue down the line.
Mm-hmm.
You'd be surprised how often they don't. And so we need to make sure that they actually do match, especially if you had a change in accountants. More and more, a lot of merger and acquisition companies are focusing on headcount. So we pay attention to some payroll data. We also will begin preliminary report pulling on revenue silos. So if you are a construction company who does roofing, siding, windows, then we're going to want numbers for those three revenue silos because that usually comes up in due diligence.
Mm-hmm.
On the buying side, it's a little bit different. We're looking for due diligence, but we're requesting that information. So we're auditing that the tax return is tied to the financials. We're asking for revenue silo data. We're asking for personnel.
Mm-hmm.
Do we have employees in all one state? Is it virtual? Those types of questions. But usually, if we can get good, clean financials and tax returns, it's a great starting place for them to us have a conversation with someone like you.
Perfect. Perfect. I love it. And so obviously I'm only going to be on the buy side, right? Never on the sell side. But here's what I'm looking for. First off, I want to make sure it makes sense. So I want to see what the assets are that are included with the business. I want to see what their net margins are, right? I want to see what their profit was on their returns. And I want to make sure one, it cash flows. Okay. Two, I want to make sure it has the collateral. And then I want to understand what type of really business it is because each bank has a different appetite. So first I want to make sure, hey, can the deal get done? If the deal can get done, then I want to make sure my client, the buyer, has everything they need to make it make sense as well. And then from there, we just check some boxes, right? Because a lot of times on an acquisition, most of the friction comes from the seller. A lot of times the seller doesn't have everything ready. And when they don't have everything ready, it's very hard to go back and forth to the bank. Just to give a quick example, like if you wanted to get an acquisition done, you can't even get that into underwriting unless you have a purchase and sale agreement or at least a letter of intent. Okay. So there are steps to this. The first would be speaking with your accountant, like Madeline, and making sure that you have everything together, making sure that you understand what type of business you want to go hunt for. And then you would, once you select one, that's when you would come and speak with somebody like me, right? Madeline, what are some of the biggest roadblocks or hiccups you see on your side?
Yeah, so I think also in addition to us, definitely talk to an attorney before you give over any type of financial information, trade secrets, collateral. Get an NDA with that LOI. Make sure that your business is protected in the event that it doesn't work out. So just wanted to
Mm-hmm.
throw that in there.
Yep.
Some of the hurdles that I see, like you said, would be just information isn't accessible or really poor record keeping.
Yes.
Oftentimes, the due diligence process is where everything falls apart, and it's just because things aren't documented. So, like right now, stop making your reimbursements on Venmo, start cleaning up just a couple aspects of business. So that way, it's very clear a little bit later. The next piece is add backs. So, for example, in the event that I wanted to sell my business, there are things that maybe I am currently paying for that that prospective owner wouldn't need to. So, for example, like I have an office rent here, but if they already have an office, then they don't necessarily need to buy another office. Or my what is it called, distributions, or my like there's just cost of doing business.
Mhm.
So kind of start to look through your financial statements with those add backs, because that can help you with, the asking price or the valuation that you come to the table with, um, and potentially so that way you're not leaving as much money on the table.
Yeah, and I think what's really awesome about what we've both talked about is we're just talking about if you're looking to buy a business, what do you need to do? What are some of the steps and what are you thinking about? And the more and more I think about the information that's going back and forth between me and Madeline, the reality is you actually need a team.
Mhm.
Okay. So when you're building that team, what does that look like? It's going to look like your attorney, your accountant, the bank, or your finance guy. And then I think your business broker, right? And the reason I say that is it's not a crazy experience, but it's something that, one, if you work with the right broker, they're going to help you find the business and vet the business a little bit easier. Okay. Two, they're going to make sure things are done the right way, meaning there are certain things that can happen in one of these transactions that can be very negative, like misrepresentations. Okay. So you want to have people that have experience doing this. So that's, I think, step number one. Go out, build your team, let them know where you stand, what your timeline is, and what you're looking for. Okay. And the team, I wouldn't introduce everybody, okay, until you're actually ready to go. But build the team, communicate with everybody, and understand what each one of them is going to need and how that process will play out as you go and you hunt for that business. Because if you do that and you're surrounded by people that have done this before, it will be much easier. What are your thoughts on that, Madeline? Because that's really step 1, 2, and 3.
Yeah, no, absolutely. I couldn't agree anymore. I think building those relationships now, and then also really understanding from a acquisition perspective, what can I afford? How long is it going to take me to cash flow? Can I, like, what does that loan payment realistically look like? And can the company that I'm buying sustain that? I think that that's probably a big part of the exercise that you do with the client, just to make sure that it's cash flowing. But potentially, as you acquire businesses, there could be a pullback or there could
Mhm.
be a seasonal change. And so just making sure that you're taking those into consideration as you do potentially take on financing to purchase. Um, for someone who's looking to acquire a business, could you kind of talk about like requirements? Some people go SBA, some people need a larger loan amount. What's cash required? Where do people start?
Yeah, so any type of acquisition, there's two ways to do it. You could seller finance or I mean, there's obviously cash, multiple ways, but I specialize with the SBA. And the SBA, even though it says it goes up to 5 million, you can always do much more as long as the bank's comfortable with it. And so in those cases, you have to have a bank that has an appetite to go above 5 million. And what they do is they just mirror the loan and they call it a pari passu loan, where the bank's holding one loan, the SBA is holding the other, and they can go up as high as they really need. Right. So I'm not worried about limitations of the banks or limitations of the SBA. What was that? The second part of that question? I'm sorry, I lost my train of thought.
I know some people go SBA, some people go private, but what are or seller financing,
Yeah.
but what are the requirements? Since you specialize in SBA, like what can someone prepare for? Are they bringing cash to the table? Are they
Yes.
bringing, like, what are they doing to secure this?
Yeah. So the SBA, really two ways to do it. 504, if you're buying it with property, or a 7A. 7A, you can still use it to purchase property, or you can just use it to purchase the business. The reality is each one of them will have slightly different requirements, but you're going to need very strong credit. So 680. You're going to need, typically I tell people 10% down. There are times it can be 20% down, and there are times it can be 5% down. What really matters is the total of the loan. What's the collateral look like? So they're all have slight variances, but for the most part, I would say 10% down, and the SBA is going to give them anywhere between 10 and 25 years to pay it back. It's going to be 10 years if it's just a straight acquisition. And if there's land or property attached with the business, that's when you can extend to 20 or 25 years. And then seller financing, here's how I tell people if seller financing is a good play or not. If the business is typically anywhere from 100,000 to, let's say, 250,000 cost, then I would say seller financing is a great way, because the SBA is very challenging for less than 250,000. Just doesn't work. Second, I would say get a term loan for a deposit, and then you can tell if it's a good deal for seller financing. Just compare it to the SBA. If you're getting rates that are under the SBA and terms that are longer than the SBA, because the seller doesn't know or the seller is willing to carry the paper so they make more money, that's a no-brainer. You should obviously do seller financing there. But if they're not, or they're giving you shorter terms, the SBA makes the most sense. And most times I would recommend the SBA because it's going to be the best and the cheapest and the longest, which means it's going to help that business cash flow the best. Does that make sense?
Yeah, makes perfect sense.
Cool.
Any type of industry data or anything that a buyer should be prepared for that the SBA might require in order to close?
Yeah, so really, really good. I was going to give you a good rule of thumb. So for every $55,000 in profit on a tax return you see, that usually equates to the SBA approving for 350 over 10 years. Okay, where current interest rates are today. Now, if there's property attached, that same 55,000 can actually qualify you for 700,000 because it extends the term because you're purchasing property.
Oh, understood. Got it.
So that's a good little rule of thumb. Like if you're analyzing a business or one of your clients wants you to say, hey, do you think we can get this approved? Use those numbers and that'll really help. There's obviously more that go into it, but that's a pretty good
rule of thumb.
Yeah.
Good. Okay. Well,
right.
I feel like that answered my preliminary questions. I'm excited to dig into some more topics, but yeah, I think that's it for today.
All right. And I'm sure we'll be speaking tomorrow. So, Madeline, thank you as always. Crushed it.
See ya.
Bye.